Okay. Good afternoon, children. Today we are going to start with trade payables turnover ratio. Okay. So trade payables turnover ratio. Yesterday we have done trade receivables turnover ratio. So this is just the opposite. I had told you trade payables is what? Sundry creditors and bills payable together is known as trade payables. Okay. So now trade payables turnover ratio. What is the formula? Net credit purchases divided by average trade payables. Okay, and your answer will be in times. Okay, so what is told here, if the amount of credit purchase is not given in the question, the ratio will be calculated on the basis of total purchase. Okay, so let us come to the first example. Trade payables turnover ratio. Credit purchase is given 6,20,000. Purchase return, this you have to subtract. Okay, opening creditors, closing creditors, opening bills payable and closing bills payable, this together is will be calculated for average trade payables. Okay, so net credit purchase will be from the credit purchase if you subtract purchase return, so that is 6 lakhs. Okay, now what you are going to do, these four figures, opening creditors, closing creditors, opening bills payable and closing bills payable, these all you will add and then you will divide by 2 to get the average. Okay, so average creditors and BP, four items you have added. Okay, and you if you divide it by 2, then you get 1,50,000. So your trade payables turnover ratio is 6 lakhs. Okay, divided by 1,50,000, that is 4 times. Okay, now yesterday also we have learned how to calculate average collection period. Yesterday we did. Okay, so our average collection is same as average payment also. This also what you are going to do, 365 days will be divided by the trade payables turnover ratio. So here average payment period will be 365 divided by this ratio, the times that you have got 4 times. So we will divide by 4. So you are getting it in days. 91.25 is equal to 92 days. Okay, now look at this. Here you have little more illustration. 78, sorry, trade receivables turnover ratio, average collection period. So many things they have told you to calculate from here. Okay, so trade receivables turnover ratio also you will calculate with that average collection period, again trade payables turnover ratio and average payment period. So these are the type of sums which are 100% expected in your practical exam in December. Okay, so practice this kind of sums. Revenue from operation is given, creditors is given, bills receivable, bills payable, purchase and debtors. Okay, clear? So now how you are going to proceed? Trade receivables turnover ratio is credit revenue from operation divided by debtors. With debtors you will add bills receivable. So credit revenue from operation is given how much? 3,60,000. Okay, 36 lakhs. And then you have debtors, this is 40 lakhs, and bills receivable 8 lakhs. Okay, so it is together when we add and divide, you are getting 7.5 times. Okay, now average collection period, just yesterday we have learned 365 will be divided by 7.5, so you are getting a direct answer over here, 49 days. Okay, so that is done for trade receivables turnover ratio. Now we will calculate trade payables turnover ratio. So here you have to, for payables you need credit purchase. Okay, divided by, it will be creditors plus bills payable. So how much is the credit purchase? It is given in the sum. How much is the credit purchase? Credit purchase, do you understand? It is how much? Tell me, can you understand? See, creditors is how much? 12 lakhs. Okay, creditors is 12 lakhs and bills payable is 60,000. Okay, so 12 lakh and 50,000. 12 lakh and 60,000 you will add, and credit purchase. Credit purchase is 15 lakhs. Okay, next what you are going to do? You are going to divide, add these two, 12 lakhs and 60,000, and you will divide by this. So you are getting 11.59 times. Okay, 11.9 roughly means 12 times. Now what you are going to do? Average payment period. This will be 365 divided by trade payables turnover ratio is 11.9. When you divide this by this, then you are getting 31 days. Neeraj, page number is 5.72. Okay, 5.72 in my book. So we have finished this third ratio, activity ratio, that is trade payables turnover ratio, and the last ratio which is left in this group is working capital turnover ratio. So working capital turnover ratio, what is the formula? See, all the formulas are concentrated with revenue from operation. So revenue from operation, what is this? Net sales. Okay, net sales divided by working capital. So now you know what is working capital. Working capital is current asset minus current liabilities. Okay, now what is the main objective of calculating working capital turnover ratio? This ratio is of particular importance in the non-manufacturing concerns where current assets play a major role in generating revenue from operation. Okay, so this ratio reveals how efficiently, underline this thing in your book if you are having the book, that this ratio reveals how efficiently working capital has been utilized in making revenue from operation. This is the objective of working capital turnover ratio. Okay, how efficiently the working capital has been utilized for making revenue from other operation. In other words, it shows the number of times the working capital has been rotated to produce revenue from operation. Okay, this is the main thing. How many times you have used the working capital to generate revenue from operation. This is the main aim of calculating working capital turnover ratio. Okay, now let us come. Here also see they have given you one note that working capital turnover ratio has been calculated on the basis of revenue from operation. Okay. So here they have told you to compute working capital turnover ratio from the following information. Here you have cash revenue from operation 1,30,000, credit revenue from operation 3,80,000, revenue from operation returns it's 10,000, and liquid assets is 1,40,000. Current liability is 1,05,000, inventory 90,000. Okay. So working capital turnover ratio, it is revenue from operation divided by working capital. So revenue from operation, how you are going to calculate? Cash revenue from operation and credit revenue from operation. Both you are going to add. From there you will subtract revenue from operation return. All the purchase return and the sales return you will subtract. Okay, so here you have cash revenue from operation 1,30,000, credit revenue is 3,80,000, and revenue from operation return is 10,000. This you are going to subtract. So 1,30,000 plus 3,80,000 minus 10,000 is 5 lakhs. Okay, so we have got revenue from operation. Next thing what we need is working capital. So working capital, you know, it will be current assets minus current liabilities. So from liquid assets, here you have liquid assets, how much? 1,40,000. Inventory is there and current liabilities. Okay, so we will utilize these three figures over here. See how we will do. So working capital is formula, you know, current asset minus current liabilities. Now current asset, how you will calculate? With the liquid asset you will add inventory, then only you get current asset. So liquid asset is 1,40,000, with that 90,000 when you add you are getting 2,30,000, and working capital is 2,30,000. Current asset minus current liabilities is given in the question 1,05,000. you subtract, then you are getting 1,25,000. Okay. So working capital turnover ratio is 5 lakhs, that is revenue from operation, divided by 1,25,000, that is working capital. So you are getting the answer 4 times. Okay. Let's come to another sum. Here it is given cost of revenue from operation. Okay. Inventory, trade receivables, marketable securities, cash at bank, trade payables, and provision for tax. Now, working capital turnover ratio, first you need what? Current assets and current liabilities. So, to calculate working capital. So, current asset, how you will calculate? Inventory you need with trade receivables, marketable securities, and cash at bank. From where are we getting this, children? This formula? Right at the beginning, where I told you on the first day, when we are calculating, we started ratios, liquidity ratio. Liquidity ratio is the first ratio we started, where we have calculated current ratio. So in current ratio, the formula is current asset by current liabilities. And I have told you to learn what are the items what are coming in under the head current assets. From there only you come to know that inventory, trade receivables, marketable securities, and cash at bank, these 4 items if you add here, you will get 6 lakhs. This is current assets. And under current liabilities, what is coming? Trade payables and provision for tax. This is all from current ratio, you will come to know. So that is 1,40,000 plus 10,000, it is 1,50,000. Okay. Now working capital. What is working capital? Working capital, you know, current asset minus current liabilities. So 6 lakh minus 1,50,000 is 4,50,000. So finally, we have calculated working capital turnover ratio, cost of revenue from operation. Cost of revenue from operation is given directly in the sum, that is 18 lakhs. Okay. So 18 lakhs divided by working capital, 4,50,000 when you do, you are getting 4 times. Okay. Now one more thing it is told here, you will keep in mind that in the absence of revenue from operation, the ratio is to be computed on the basis of cost of revenue from operation. So here what did you get? You have got cost of revenue from operation. Okay. So that means that if revenue from operation is not directly given to you in the sum, then you will calculate cost of revenue from operation. Okay. Now we are coming to the last sum. Last sum is, see, current asset and current liabilities directly you are getting. So this is what? Working capital. Current asset minus current liabilities. Cost of revenue from operation is given to you in this sum. Okay. And extra some additional information is given. This is gross profit. This is 20% of cost. So why you need this gross profit? To calculate revenue from operation. Okay. So let's proceed. See, revenue from operation. Revenue from operation is cost of revenue from operation plus gross profit. So cost of revenue from operation is 10 lakhs and gross profit is 20% of cost. That means 20% of 10 lakhs if you do, you are getting 2 lakhs. 10 plus 2, 12 lakhs. Okay. So this was the reason gross profit was given in the sum. Okay. And working capital, how you know now? Current asset minus current liabilities, directly you can calculate. It is 1,50,000. So 12 lakhs divided by 1,50,000 is 8 times. So your sum is ended over here. And the last sum on working capital turnover ratio. See, current asset and current liabilities is given. Okay, this you know. See, cost of revenue from operation is given. Gross profit we did just now. It is told 20% of revenue from operation, and shareholders fund is also given here. So now see, revenue from operation. Revenue from operation is what? Cost of revenue from operation, just now we calculated. With that gross profit you will calculate. Okay. But gross profit is given that it is 20% of revenue from operation. So now see how they have calculated. Revenue from operation is includes the profit of 20% on revenue from operation. Therefore, goods costing 80 must have been sold for rupees 100. Here what they are telling, 20%. Okay. So 20 minus 100 minus 20 is 80. So 80 is the goods cost. Okay, cost price of the goods is 80 and the selling price is rupees 100. Okay, so that is what is told. So if the cost of revenue is 80, revenue from operation is 100, and here they have given you cost of revenue is how much? 10 lakhs. So revenue from operation by unitary method, 100 by 80 into 10 lakhs is 12 lakh 50,000. Okay, so this is how we have calculated revenue from operation. Okay, now working capital directly, you know, current asset minus current liabilities, done. So it is 1 lakh 25,000. Now working capital turnover ratio, 12 lakh 50 by 1 lakh 25, it is equal to 10 times. So you are seeing, children, that all the ratios, today we have completed this working capital turnover ratio and trade payables turnover ratio. So these four ratios, activity ratios, is complete today, and you are seeing that each sum on ratio is having almost 3 to 4 varieties. So you need to practice all the varieties of sum, so that if the examiner is asking you also, you are able to give the answer, and you're going to give your practical exam also based on this. Okay, so today we are finishing this activity ratios, and tomorrow we will start what? Only one ratio is left, that is profitability ratio. So profitability ratio we will continue tomorrow. Okay, if you have any more questions, you can ask, children. Those who are there in the class, please give your attendance. Those who are attending the class, please give your attendance by writing present, ma'am. All those in the class. 4 of you are there, so you can write. Yes, shareholders fund, Pune, there is no need. See, they have given a note at the end. Shareholders fund will be ignored. Okay, this is and information which is given just to what? Confuse you. Nothing is required for the shareholders fund. Shareholders fund has got no here, no work over here. Okay, Puneet, it is clear. So, and yes, what is your question over here? Ashish, ma'am, accounts project topic I have given today. Have you gone through class 12's? There I have given you the topic today. Okay, it is specific project. Specific project is this financial statement analysis. You will include this chapter, ratio. Okay, and the next chapter, that is cash flow. Clear? Okay, so thank you all of you. Tomorrow we will start with profitability ratios. Okay.